Well, what did you think of that valuation? Because I saw also some takes about that on crypto Twitter.
Yeah, I mean, I think five's high. I have looked at it in the past. I am probably a buyer somewhere between 2 and 3, but I don't know if the market gets there. I think there is part of this story, which is there is not pure play stablecoin exposure in the public markets today. And if you want that, there's ways to get it. Like, you can obviously become an investor in Coinbase and you get this nice little revenue share that flows in from Circle. You can invest in PayPal, which obviously has their stablecoin today. There's a number of different equities that you can invest into if you want that type of exposure, but there's nothing as pure play as investing in Circle. And so there's a world in which Circle is this limited asset. You know, there's not a lot of different ways to express this view that stablecoins are going to eat traditional payments. And so then if you want that, maybe there's a world in which you're like, okay, there are challenges in a variety of different senses, and that's okay. I want to own this business in this category that's certainly going to keep growing, and this is my way to express that bet. And so I can see both sides of it for sure. You know, personally, I still find making a bet at that price is expensive.
Hi everyone, welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. We are now featuring quotes from listeners on the show. Today we have a few responding to my interview with Infinex founder Kane Warwick. On X, Garth Trader says, quote, "I always enjoy the conversations on your show. We need intelligent dialogue to move past the narrative of this being a space full of scams." And also on X, Manu writes, quote, "Infinex is looking like a real change maker in the space, and they made it all look so simple. Makes you wonder what took so long." To have your comment featured, write a review of the podcast overall, or leave a comment on our video on YouTube or X. This is the April 4th, 2025 episode of Unchained. Bitkey is the Bitcoin wallet from the team behind Square and Cash App. It's the first 2 of 3 multi-sig hardware wallet with recovery tools that replace the need for a seed phrase. Get 20% off with code UNCHAINED. An AI that speaks crypto and does the work of a team of analysts. Introducing Focal by Falcon X, bringing clarity to a world of noise. Visit askfocal.com. Mantle is building the future of on-chain finance. Experience its enhanced index fund, Mantle Banking, and Mantle X. Visit group.mantle.xyz to learn more. Today's guest is Omar Kanji, partner at Dragonfly. Welcome, Omar.
Hey, Laura, how are you?
Good. So we're here to discuss Circle's S1, which it filed to list its IPO on the New York Stock Exchange under the ticker CRCL. And this was actually the second time that Circle's attempted to go public. The first time was as a SPAC merger in 2021, which ultimately didn't go through. Crypto Twitter really enjoyed dissecting this S1. When you looked it over, what stood out to you?
Yeah, there's a number of things, I guess, that stood out when I looked at it. First, we've always gotten this anecdotal reporting from Tether, and it's a subset of their underlying financials, and they highlight a number of things which highlight the strength of their business. And Circle's was a broader look and at a much more refined level into that company, and seeing everything that's happened since they last tried to go public with the SPAC, and how things have developed over the years and what that's meant in terms of getting distribution and getting their stablecoin out there. And so it was just fascinating to dig into the various line items and really see what was happening behind the hood in the story.
So the biggest point that I saw people discussing was the distribution fees that Circle pays. For instance, in 2024, Coinbase received more than half of Circle's revenue, $900 million or slightly above. And that was pretty much little cost to Coinbase. And similarly, in November, Circle and Binance struck a 2-year deal in which Circle paid Binance a one-time fee of $60.25 million and a monthly incentive fee that ranges from a double-digit percentage of USDC on Binance to high double-digit percentages. And that's in exchange for Binance holding a certain amount of USDC in its treasury. And I wondered how you thought Circle, or whether or not you thought Circle could deal with these high distribution costs in a way that, could somehow lower them, or will these always be, a big chunk, take a big chunk of their revenue?
Yeah, I think it's almost a necessary step for the business to continue to scale in any way, shape, or form. If you just look at the state of the world, there's so many different stablecoin issuers now that are competing for a piece of the pie. And when you look at where the users sit, they tend to sit on these different CeFi venues or they sit in fintech applications. And for all of them, they are effectively presented with a menu of stablecoins to choose from. And in some cases, they're presented with a single stablecoin to choose from. And I think when you look at the world through that lens, the only way you can get your stablecoin into the hands of those users is by paying and doing these distribution deals. And so that's like exactly what happened. Obviously, Coinbase Circle is a story that's gone on for a very long time, almost since the inception of Circle. But if you look at some of this stuff they're doing today, whether it's Nubank or whether it's Binance, these are or Grab, there's a number of different deals that they're doing to get their product into the hands of users. And if you don't do those deals, they'll just never happen. And so the question then becomes how much of the economics can you keep versus how much do you have to give away? And if the platform that they're doing the deal with owns this user and can monetize them in a number of different ways, they arguably should get the lion's share of the economics. And we're seeing that play out throughout their financials.
And out of curiosity, I'm not sure about this. So obviously, like a place like Coinbase doesn't have USDT, but do you have an awareness of whether Tether similarly pays such a high amount in fees to other exchanges?
Yeah, it's all undocumented, and my interpretation is that the vast majority of the time they don't. It's a function of their role in the market and how long they've been around, and the market share that they've got, and the network effects USDT is accrued. And so I would bet that their underlying economics do not look anywhere near to what circles do.
Oh, okay. Okay. Right. There's sort of kind of like, what's the word? There's sort of like an oil in the system that is a little bit more necessary than USDC is at this point. So I did see, the other talking point was people were noticing how dependent Circle's revenue is on interest rates. And one little factoid a number of people called out was that even just a 1% decrease in interest rates, I'm not talking about a single percentage point, but just a 1% decrease in that rate could reduce the stablecoin reserve income by $441 million. This is at Circle. And yeah, and so people were, wondering about that. Meanwhile, Circle itself was arguing that a decrease in interest rates could result in a rise of USDC in circulation.
Yeah,
But I don't know what you thought of that rationale.
yeah, no, for sure. It's funny to see the impact rates just have on these businesses. And if you think about them at like a very basic level, you're buying, and if you think about it from the way you would be purchasing this IPO, you are buying equity in a company that takes other people's money, invests it into treasury products, and gets a portion of that as income back to you as an equity holder. And so it's probably like a levered bet on rates and where those rates go over time. And I think, yeah, it was fascinating. Like a 2% move in rates, just to add to your point here, it cuts their total top line in half. And the Fed, and I mean, obviously there's a lot going on in the broader markets today, but there was two forecast cuts for this year. Like there's a 90% chance of that happening. If you extend the duration over the next couple of years, there's a series of cuts that are going to be priced in. There's a view as to where long-term economic rates go. Historically, it's been 2%. Today, given some of the structural issues, maybe that sits a little bit higher. But I think the general consensus view is that rates over any material period are going to end up lower than they are today. And so it's a question of this is a falling knife. You will try and catch it. You will try and pay a fair price for this falling knife. And ideally, you can get a lot of distribution so that the rates, when they do inevitably go down, are offset by the increase in the supply of USDC. And in turn, you end up making an equivalent amount of money. And so I haven't been as surprised, to be frank, just given that I guess I'd watched the whole thing happen on the way up and now I'm watching it come back down. But it is incredible to see just the sheer amount of money that stablecoins print as interest rates do go high. And when you can reach material distribution, the numbers start to look really, really big. And, I mean, in 24, there's Circle's top line was $1.6 billion.
Yeah, I mean, I like I agree with everything that you said there. It's just like that future bit. There's so many variables because it's like, yeah, they could increase the amount of USDC in circulation, but then it's also like there's going to be other competitors, new competitors. It's not just Tether. So then there's just so many variables that could affect that number.
Totally. This is exactly why they're doing those distribution deals, because they see all of these competitors coming in. They recognize the market is largely up for grabs, and they know interest rates are going down. And like as a function of their business, they just need to continue growing and make USDC the canonical stablecoin across the industry.
Yeah. We'll talk about this in a moment, but like looking at it, I was kind of like regulation might be the deciding factor. But yeah, we'll get to that in a second because I did also want to know the other thing crypto Twitter was, chatting about was the compensation costs. They were very high, more than 250 million a year, another 140 million a year in general and administrative expenses.
Yeah.
And I wondered what you made of that, whether or not you saw any way for them to lower those.
Yeah, I think like as a headline number, it's shocking. As like if you really dig into it, is it crazy? There's like 900 employees, it's like 300K of a head. Like that's not that bad. Obviously expensive. But if you take some time and you like dig through the S1, you'll see there's a ton of effort going into regulatory compliance across jurisdictions. And making sure that they are represented at a political level across every jurisdiction globally, and so you can begin to understand where the compensation and the G&A costs start to flow through. I think from a technological perspective, like if the only thing was this is a tech story and this is how much they're spending, and stablecoins today, as great as they are, they're not really technologically innovative. I think it would be hard to wrap your head around some of those numbers. But when you look at it from the perspective, okay, they're playing a game on a number of different fronts, both, in Congress, outside of Congress, globally, then it starts to make a little bit more sense. But, I think anyone that's investing is hopeful that over time they can scale some of these costs down. And it's hard without the requisite granularity to really get in there and see exactly what is going on underneath the hood. But the hope is over time they can make the business a little more with a little better operational leverage. Yeah.
One last comment on that. DeFi people always say, like, what is it? I forget, something in the front, party in the back.
Yeah.
Yeah. To me, looking at at circles as when it's a little bit like stablecoin in the front, compliance in the back.
Yeah.
But interestingly, like even though that seems like it would be an edge, we reported here in a news article that, Jeremy Allaire was not at the White House Crypto Summit, and we got this source, which, I don't remember how we expressed in the article. So people read the article to find out how we described the source. But the source said that it was due to Howard Lutnick that he ended up not there. So, and Howard Lutnick, for people who don't know, he's a former investor in Tether. He had to, I think, divest for his Commerce Secretary role, but.
Yeah, exactly. Yeah, there's various ties to the whole Tether side of the story, and it's funny just to see the way Tether's articulated throughout that S1. It certainly seems like this big bad wolf that operates on the other side of the world that's doing all kinds of nefarious things, and Circle certainly positions itself on the other side, which is a smart play that they very much should be doing as they file this S1 and go market their story. And, they come as like, the regulated payment stablecoin that is clean and, doing all of the right things.
Yeah. I mean, that playbook definitely worked for Coinbase, but, we'll see how this plays out for Circle. So in a moment, we'll talk a little bit more about, just what we can expect from the market reaction to this Circle IPO. But first, a quick word from the sponsors who make the show possible. BitKey is the only Bitcoin wallet on Time Magazine's Best Inventions list of 2024. Built by the team behind Square and Cash App, BitKey is a 2 of 3 multi-signature wallet and the first hardware wallet with an innovative recovery suite that eliminates the need for seed phrases in self-custody. Their new inheritance feature means BitKey's not just the easiest way to self-custody your Bitcoin, it's the easiest way to ensure it ends up in the hands of loved ones when it's time for it to leave yours. Learn more at bitkey.world. bitkey.world. Use code Unchained for 20% off. Picture this. The crypto market just got wrecked by billions in liquidations. You need to figure out what happened and what's next. But where do you even start? Meet Focal by FalconX, your AI-powered crypto analyst. It's like having a legion of experts at your fingertips, ready to break down market-moving events, chart DeFi protocol TVL, or explain why Solana mindshare is rising. Get clarity in a world of noise with Focal. Learn more at askfocal.com. We have another listener comment, this one in response to Infinix founder Kane Warwick's explanation of the crypto community's reaction to Hyperliquid's jelly fix. On X, Luke Desai says, quote, changing protocol rules mid-game is exactly why DeFi keeps failing. Transparency first, changes second. Jelly proves this point. Again, if you want to hear your comment featured on the show, please write a review or leave a comment on an episode on YouTube or X. Back to my conversation with Omar. So you wrote a tweet, analyzing this S1, and one of the things you wrote was 32 times the 2024 earnings for a business that just lost its mini monopoly and is facing several headwinds is expensive when growth is structurally challenged. So what are these structural challenges you see to Circle's growth? And do you think there's any way they could overcome them?
Yeah, I think like the big part of the Circle story that is challenging for public market investors is like not only number one, are you wearing a lot of regulatory risk, which is at any given moment, one of the various different bills that is working its way through the various forms of US government could pass and fundamentally alter the entire landscape of this industry and in the way these companies operate throughout the US. So you have this big, bogeyman in the closet that you're potentially dealing with at any given point in time. And it's very clear from everything that's happened in the US government today and since the Trump election that there is going to be some more clarity ahead. Something will get through, there will be some guidance. And so you have this backdrop of regulatory clarity for the first time in a very long time. And I think, with that also comes like some of the huge competitive challenges the business faces, which is the second there is regulatory clarity, this sandbox that crypto companies have fortunately been able to play in and build great businesses around is now a global sandbox, and everyone is allowed to join the party. And I think Bank of America, you see all this stuff going on throughout the news, and you see all this reporting. Everyone is just waiting to get into this game, and they're waiting to get in because it's a phenomenal business. You can take in a deposit, you can make money off that, and you owe nothing to that customer. And ultimately, it's like a better version of an insurance company. And there's, if you go to a bank, it's a bank with no regulation really, and it is a phenomenal business to be in, and a lot of people would love to be in it. And a lot of people have really great brands that they can use to distribute a product like stablecoins globally. And they have physical locations, they have huge digital presences, they have massive marketing budgets, they have similar companies that they can work with and have a huge consortium approach. There's a lot of different things that they can do once they have the clarity that, okay, you are allowed to enter the industry. And so I think when you look at it from an equity investor perspective and you say, hey, I'm going to invest in this business, you're like, okay, this company has done great. They've really done a good job. And, they've survived some really hard times. SVB, I'm not sure if you remember, but there was the whole Circle DPEG. And that was tough. Their circulating supply went down. They were close to 60 billion a few years ago, went down to, the 20s. And today, fortunately, they've grown back. But the business has been through a lot. It's survived, it's scaled, all these things. But you look at this business, then you look at what's happening in the future, and you're like, okay, do I really want to pay up for a business like this that has a number of challenges ahead, that might not be able to make its own mark and not be able to continue scaling and growing? And at the same time, interest rates are certainly going down. And so you have this really tough backdrop for a company that's going to market and trying to sell their story and saying, hey, you should pay for my equity at $5 billion when I have all of these challenges ahead.
Yeah. Well, what did you think of that valuation? Because I saw also some takes about that on crypto Twitter.
Yeah. I think five's high. I have looked at it in the past. I am probably a buyer somewhere between 2 and 3. But I don't know if the market gets there. I think, there is part of this story, which is there is not pure play stablecoin exposure in the public markets today. And if you want that, there's ways to get it. Like you can obviously become an investor in Coinbase and you get this nice little revenue share that flows in from Circle. You can invest in PayPal, which obviously has their stablecoin today. There's a number of different equities that you can invest into if you want that type of exposure, but there's nothing as pure play as investing in Circle. And so there's a world in which Circle is this limited asset. There's not a lot of different ways to express this view that stablecoins are going to eat traditional payments. And so then if you want that, maybe there's a world in which you're like, okay, there are challenges in a variety of different senses, and that's okay. I want to own this business in this category that's certainly going to keep growing, and this is my way to express that bet. And so I can see both sides of it for sure. Personally, I still find making a bet at that price is expensive.
So let's circle back to your regulatory comments because, as we speak, these stablecoin bills are moving through Congress. There's one in the House, which just passed a vote on Wednesday. That's called the Stable Act. Then, for those of you who remember the Staple Genius reference, there's the Genius Act in the Senate, which passed the Senate Banking Committee last month. And, I am seeing that crypto executives at the same time are trying to see if they can work into these bills that, Congress allow interest to be paid on these stablecoins. And I wondered how you thought that might affect, as well, really Circle's business, but really, any stablecoins business. Like, how does that affect the competition?
Yeah, I think like if you just look at it purely from an economics perspective and you say, okay, stablecoin issuers are now going to pass on all of the yield they generate, the business becomes extremely unattractive very fast. And the reason being, like today, you in effect get to hold a dollar, make all of the interest income off of it, and then at some point in time, you end up redeeming that dollar back to the customer when they decide they want their money back. And so you get all of that today, 4.5% is yours. If you start passing along all of the interest, that 4.5% is no longer yours. It goes back to the customer. And so the business itself ultimately ends up becoming quite unattractive. And there are iterations of this product live. BlackRock's Biddle fund is on chain, and it's a tokenized treasury fund. And all of that interest goes back to the treasurized token holders. The way they make money is the small 20 basis point fee. And so that business model, relatively speaking to a stablecoin model, is just not as appealing. At the same time, passing along yield back to customers is for all intents and purposes, a security. And I think Circle says as much in their S1. And everything that you have seen broadly online is if stablecoins start passing back yield to to token holders, their securities, they're effectively bonds. And so I think there's a few different elements to it in the way that I see the world. I think, from a utility and usefulness perspective, that is certainly a better version of the world. Like your digital dollar, you should very much get the yield that goes along with your digital dollars that are being locked up. And, it's great to see across like the crypto world today, the number of improvements that have been made in that regard for investors in a number of companies. But, one of them has been able to get into the tokenized collateral space where when you put on a derivatives trade, the margin that you are using ends up earning you yield, which reduces your margin requirements. And it's a really great way to make money more useful. And so it's been awesome to see that. I mean, Circle as a company itself, they bought Hashnote. They have USYC, which is their tokenized money market product. So they certainly see that part of the world starting to grow and evolve. And I guess, the two sides of the world are if you're allowed passing yield back to token holders, to stablecoin holders, you end up being a security issuer. You end up not having as great of an economic model, but you end up providing a better product to customers. Then on the flip side, if you can't, then you get to keep your great business, but at the same time, customers are dealing with slightly less useful money, but at the same time, you're giving them US dollar access. So I guess those are the broad different ways of looking at it.
Yeah, honestly, like just thinking about all these different factors we've been discussing, including like compliance costs and everything, a part of me is just like, Oh, all this stuff we always talk about on the show, like DeFi, AI, like you could just see such a better product where you don't have to do the compliance. You just have something more that's software, but the algorithm is like really smart and knows how to do it all where, customers get a competitive product and get, some of this interest, and yet you don't do it in a way where like DAO token vote holders might, for instance, do something that's in their interest, but against the interest of the long-term sustainability of the actual stablecoin. Anyway,
Totally.
totally going down a rabbit hole. But you alluded to this earlier. So because of the regulatory clarity, we will likely see a bunch of new entrants like banks and stuff like that. What do you kind of think might happen going forward? Because we're at this inflection point for sure. So what do you think the stablecoin space generally might look like over the next, year or two?
Yeah, I think initially what ends up happening is like the legacy institutions are slow and they get this clarity and then they're like, okay, it's time to move. And that period from time to move to launching a stablecoin probably looks something like a year, probably even longer actually. But I think one of the things that is true of large financial institutions is they don't move that quickly, for better or for worse. And it's why we have the safety and stability, but at the same time, why there's not necessarily, a ton of innovation. But I'd say like it does take time. Some of like the smaller financial institutions that are looking to get market share, look to enter a new category, I could see them moving quite quickly. We're seeing some stuff with various states even here in the U.S., but I think you start to see it play out on a number of different levels. And I think over time, what happens is initially is heavy fragmentation, which is like there are hundreds of stable coins in every currency that is applicable. And then over time, I think what ends up happening is just consolidation. We go through this like it's relatively consolidated today. There's let's say like 10 to 12 different players in this market. That's 250 or so billion. 5 years from now, it's a multi-trillion-dollar market. You have probably 30 to 50 different issuers that are material in size. And then at some point, it ends up consolidating back, and maybe the banks all enter into a consortium, and they have what looks like card network type economics, or or people end up going and acquiring different businesses, and like there is just a small series of brands that end up existing and accounting for the bulk of different stablecoin supply throughout the world. And I think it bifurcates globally, where certain stablecoins are popular in certain geographies, very much as it is today. And so you have some in North America, some in Europe, some in Asia that end up dominating supply in those regions. There's pretty broad interoperability. I think you start to see the rise of foreign currency stables. Today that has not necessarily played out. The euro stables are relatively small today, but we start to see the rise of different stable coins across different geographies start to pick up steam and traction as you can integrate them more into everyday applications that you use throughout your life in each of those geographies. And so, I think fragmentation, consolidation, just like a lot of different industries, and that's a couple of really big winners.
Yeah, that totally makes sense. Well, I did want to ask just a couple questions about the thing that everybody is still reeling from as we record, which is the tariffs that were just
Yeah.
implemented. And I wondered, that's kind of like the next sort of wild card that could affect the stablecoin business in some way, and obviously Circle's IPO. So, what do you think might happen there?
Yeah, I think okay, I started my career as a banker, and the one thing the public markets do not love, especially at IPO time, is volatility. And I think if you were to look at the way the world generally tends to work, is people are trying to price in equity. And when prices are moving all over the place, there's a lot of volatility and multiples are changing in real time, and no one has any certainty. Like their existing book needs to be rebalanced, their future investments kind of fall to the wayside in some ways, and evaluating new companies anyways. Their existing portfolio is dealing with all of these implications throughout the real world, especially in a backdrop where there's tariffs. And there's so many tariffs and so many different types of tariffs, and the tariffs are changed by geography. And so the implications to your existing portfolio are dramatic. And so I think what that ultimately ends up meaning is like it is hard to get comfortable on taking a new risk and adding that into your portfolio and having a ton of conviction and having conviction that it's going to survive and thrive in this regulatory environment. And so I think unfortunately for Circle and unfortunately for a lot of the companies that are queued up in this IPO pipeline, this volatility is really not great. It's not great from new investors getting up to speed on the story. It's not great from a pricing perspective. Multiples, as markets are volatile in the way that they are today, prices are going down and not up. And so that means, your equity is less valuable as opposed to more valuable. And I think the ability to raise more money is more challenging, and you end up having smaller deals if they do get done. So overall, I would say it's not good from a variety of different vectors. And hopefully in the coming months, things settle down a little bit and, we end up seeing things start working out.
Yeah, because there are a number of crypto companies that have been rumored to be eyeing IPOs, such as Ripple, Kraken, Gemini. There are others. But I guess we'll just have to wait to see how it all shakes out. Yeah. Thank you so much, Omar.
Yeah, no, thank you very much for having me, Laura. It was a pleasure.
Don't forget, next up is the weekly news recap, today presented by Wondercraft AI. Stick around for This Week in Crypto after this short break. Mantle is revolutionizing its on-chain financial hub. Powered by a $4 billion treasury and proven products like Mantle Network and METH protocol, Mantle is launching 3 innovation pillars: Enhanced Index Fund for optimized crypto exposure, Mantle Banking for blockchain-powered banking, and Mantle X for AI-driven innovation. Experience the future of finance with Mantle, and follow Mantle on X to stay tuned.
Welcome to this week's Crypto Roundup. In today's recap, we break down how crypto reacted to Trump's long-awaited tariffs and what it all means for the future of the U.S. economy, dollar, and Bitcoin. Additionally, we break down the latest in the SEC loosening its grip on crypto as incoming chair Paul Atkins makes his way through the confirmation process. We examine the Trump family's latest crypto venture and provide details on the latest companies tapping capital markets to add to their Bitcoin stashes. Plus, Congress reaches a flashpoint over a key provision in a piece of forthcoming crypto legislation. Thanks for tuning in to the weekly news recap. Let's begin. Crypto sours on Trump's tariffs. U.S. President Trump's long-awaited Liberation Day tariffs, which included a 10% across-the-board tariff and widespread reciprocal tariffs targeted at specific countries, immediately reverberated across global markets. Crypto was particularly hard hit because it was one of the few ways for traders to express market sentiments right after the announcement, which came following market close on Thursday. As of Thursday evening, Bitcoin is down 5.69 as it tries to stay above $80,000. Ether is down 6.91%, and Solana has fallen by 13%. Large-scale indices such as the Nasdaq 100 and S&P 500 are down 5.91% and 4.84% respectively. Traders are anticipating a prolonged period of economic stagnation. The U.S. now has a 47% chance of incurring a recession in 2025, according to prediction site Polymarket. As difficult as this period may be, there is a chance that such an economic climate could finally provide Bitcoin with a chance to prove its worth as a store of value, particularly if the economy falls into stagflation for the first time since the Arab oil embargo in 1973. Much like the 1970s was a breakout period for gold, which had an average annualized 31% return, I believe that the coming decade will be a breakout period for Bitcoin, said Zach Pandel, head of research at Galaxy, in an interview with Unchained. It's the right macro asset at the right time, and we have significant improvements in market structure creating more investor access to the product. Will Bitcoin finally threaten the dollar? Bitcoin could unseat the dollar, at least if BlackRock CEO Larry Fink is to be believed. In his eagerly awaited and thoroughly scrutinized annual shareholder letter, the leader of the $11.5 trillion asset manager wrote that if the U.S. doesn't get its debt under control, if deficits keep ballooning, America risks losing that position to digital assets like Bitcoin. This warning comes at a critical time for the U.S. dollar, not only because of the global economic uncertainty unleashed by Trump's tariffs, but also because of rumored plans behind the scenes in Washington, D.C., to weaken the U.S. dollar as a way of making American exports more competitive. Unchained reported this week on a plan previously proposed by Stephen Moran, chair of the White House's Council of Economic Advisers, to circumvent the government's reliance on the U.S. Federal Reserve to reduce interest rates to stimulate growth. This proposal is part of a broader plan to develop what Moran called the Mar-a-Lago Accord, which is designed to make the U.S. dollar drop in value vis-a-vis other world currencies. The plan was laid out in a paper from November 2024, when he was a strategist at Hudson Bay Capital and prior to his White House appointment. In the paper, he also suggested that the U.S. government charge foreign purchasers of U.S. treasuries as a way to depress the U.S. dollar. For Larry Fink, his Bitcoin pronouncement has a bit of self-interest since BlackRock operates the largest spot Bitcoin ETF in the world, with assets under management of $10.5 trillion. Plus, the company just incorporated Bitcoin into one of its model portfolio accounts that offers exposure to alternative assets. SEC and Gemini ask for a timeout. Another SEC action against a prominent crypto firm looks as if it is close to a resolution. On Tuesday, crypto exchange Gemini and the SEC filed a joint request for a 60-day stay of all deadlines in this case to allow the parties to explore a potential resolution. In taking this step, the SEC is using the same tactic that it employed in its cases against Binance and Tron, both of which were granted. The SEC initially sued Gemini, along with the digital currency group-owned trading firm Genesis Global Capital, in January 2023, over what it called the unregistered offer and sale of securities to retail investors through the Gemini Earn crypto asset lending program. The complaint demonstrated that in December 2020, the two firms entered into an agreement where Gemini would loan customer funds to Genesis in exchange for interest that would be paid back to investors. However, the assets, which totaled $900 million from 340,000 customers, ended up getting locked at Genesis in 2022 as the company didn't have enough liquid assets to meet redemption requests as part of the unraveling and fallout of bankrupt crypto exchange FTX. The company eventually enabled customer withdrawals in 2024 as part of its bankruptcy proceedings. The stay action comes just 2 months after the SEC closed a separate investigation into Gemini, ostensibly to evaluate whether it was selling unregistered securities without recommending an enforcement action. In other SEC news, the regulator officially dropped its cases against crypto exchange Kraken, Ethereum development studio Consensus, and trading firm Cumberland DRW. All three firms had noted in recent weeks that these dismissals were forthcoming, making the actual news a formality. Additionally, the nomination of crypto-friendly businessman Paul Atkins to become SEC chair advanced out of committee on Thursday to a full Senate vote. Gamers not impressed by GameStop's debt package. A trendy strategy in the corporate world is to follow Michael Saylor's strategy, formerly known as MicroStrategy, and put Bitcoin on the corporate balance sheet, but not everybody is impressed with that approach. Mimaisadoc GameStop announced on March 27th that it planned to raise between $1.3 to $1.5 billion in convertible senior notes, paying 0% interest for general corporate purposes, including the acquisition of Bitcoin in a manner consistent with GameStop's investment policy. According to an SEC filing, the company successfully completed the sale on April 1st, netting $1.48 billion for the already cash-rich company. However, GME investors were less than enthused. Since the announcement, the stock is down 13.27%. But that is not the only big player in the corporate finance world buying Bitcoin. Bitcoin miner Mara, which already has 47,600 Bitcoin, $3.9 billion on its balance sheet, announced a plan to sell $2 billion in stock to fund additional Bitcoin purchases. Trump family gets into the Bitcoin mining game. The Trump family crypto empire is expanding. The U.S. president's sons Eric and Donald Trump Jr. have partnered with Bitcoin miner Hut to launch a new Bitcoin mining joint venture called American Bitcoin. American Bitcoin aims to become the world's largest, most efficient pure-play Bitcoin miner while building a robust strategic Bitcoin reserve, according to a Hut press release. For the Trump family, this entry in the mining market comes at a time of challenging economics. Hash rate, a metric of the total computing power on the network, continues to set all-time highs as it approaches 900 million terahashes per second, and the price of Bitcoin sits in the low $80,000, down over 20% from its all-time high in January. This means that the mining environment is increasingly competitive while the payoff remains stagnant. Tariffs are also expected to impact U.S. Bitcoin miners who have their supply chain rooted in Asia. Countries such as China, Thailand, and Malaysia are being hit with significant tariffs. Reuters also reported this week that the Trump family has solidified its control over its decentralized finance platform, World Liberty Financial. DT Marks, DeFi LLC, an entity linked to Donald Trump and his family, now holds a 60% equity stake in WLF Holdco LLC, which replaces World Liberty Financial co-founders Zach Folkman and Chase Harrow as controlling parties. Fidelity lets investors put crypto in their retirement accounts. Boston-based asset manager Fidelity Investments is now letting individual retirement account investors put crypto assets such as Bitcoin, Ether, and Litecoin into 3 different types of IRAs. Fidelity is committed to offering investment products and solutions to meet the changing needs and interests of our customers, accompanied by education and support, a Fidelity spokesperson told The Block. However, there are important considerations for investors to weigh before putting assets into these tax-advantaged accounts. Investors for retirement typically look to tamp down risk as they get older, something that can be in conflict with volatile assets such as Bitcoin. Congress bickers over whether to bail out stablecoins. Members of the House Financial Services Committee feuded over whether or not to add an amendment banning Congress from bailing out stablecoin issuers should they become insolvent as part of the Stable Act, a proposed piece of legislation to regulate the $235 billion stablecoin market, in a markup session on Wednesday. None of the 3 amendments raised by Democratic representatives Brad Sherman, Bill Foster, and Stephen Lynch were approved. Still, the discussion was illustrative because it highlighted Democratic frustration with the close ties between the crypto industry and many of their counterparts on the committee, as well as general concerns about the stability of the crypto industry overall. Members of Congress who pushed back against the amendments, such as Committee Chair French Hill, argued that the bill already prohibited bailouts, so a separate amendment was unnecessary. In their arguments, several Democratic legislators pointed to the $60 billion stablecoin USDC issued by the company Circle Internet Financial Limited, which just filed to go public, as a cautionary example. Its price fell to $0.88 after the run on Silicon Valley Bank in 2023 because $3.3 billion of its $32 billion in reserves held at the failed bank were uninsured. That led to a run on the asset. The FDIC ultimately took over the bank to make depositors, including Circle, whole. And that's all. Thanks so much for joining us today. If you enjoyed this recap, go to unchainedcrypto.com/newsletter, that is unchainedcrypto.com/newsletter, and sign up for our free newsletter so that you can stay up to date with the latest in crypto. Unchained is produced by Laura Shin with help from Matt Pilchard, Juan Aranovich, Megan Gavis, Pam Majumdar, and Margaret Curia. The weekly recap was written by Stephen Ehrlich and edited by Carrie McMahon. Thanks for listening.